Good afternoon, everybody, or good morning, depending on where you might be joining us from. If you're on the East Coast or the Midwest, even, or I guess even the West Coast, maybe it's afternoon everywhere. Anyway, Bob Vandy, Advisors, Insurance Brokers, New York Long-Term Care Brokers. Great to be with you, and great to have both Cindy and Kyle with us this afternoon. Obviously, we know that we've got new product for those of us here in the state of New York. Obviously, we work all throughout the country, but I know a number of you are from New York State, so you're keenly interested in what both Cindy and Kyle have to share today. Now, Kyle's going to be sharing some information on, I don't want to steal his thunder here, but on the CareMatters Annuity product, which unfortunately we don't have here in the state of New York. But as we typically do, just because you happen to be as an advisor in the state of New York doesn't mean you don't have clients who either live outside of the state of New York or perhaps have second residences outside of the state of New York and whatnot, who might be able to avail themselves of that product if it makes sense. So we'll talk about that. We'll talk about taxation and some tax benefits, just to keep that fresh in everybody's mind. Cindy was kind enough to do a sort of a review of the new CareMatters 2 product in a little bit more in depth here recently, but we'll revisit that a little bit as well. From a housekeeping standpoint, yes, we've got the lines muted. Obviously, not everybody's first Zoom rodeo, so you know how this goes. The lines are muted, but we are recording the session today, and we'll put it up on the archive training page at our website in a day or two. So you can revisit it. You can share it with your colleagues, whatever the case may be. Always good content there. Other than that, look forward to seeing everybody at our upcoming carrier days, our long-term care carrier days. You're going to see either Cindy or Kyle at those events if you're joining us, depending on where you're going to be joining us. So we're looking forward to that. That actually is here starting next week. Hard to believe. Seems like just yesterday, Melissa and I were kind of planning out mapping out our plan of attack there. So looking forward to seeing everybody there. With that, both Cindy Horwath. Is it Horwath or Horwath?
It's Horwath. It's my husband's
Okay.
name. Don't worry about it, Bob.
You still don't pronounce it right either then, if it's his name?
Yeah, exactly.
Thanks for the save there. Appreciate that. And Kyle Lucas is here with us as well. I think it's no secret Nationwide is one of our key carrier partners that we have here at AIB. They're always, not only do they have great products, great support, they're always willing to step up and help us out when we need it. Today's just yet another example of that, as is their participation in our upcoming long-term care carrier days. So we really, truly appreciate their partnership. And without further ado, I'll shut my mouth and turn it over to our guests of honor today. Cindy, I think you're going to kick us off, so I'm going to go ahead and turn it over to you. Welcome both to you and to Kyle. Great to have you guys here. Cindy, go ahead. The floor is yours.
Thank you so much, Bob. Appreciate it. And thank you, everybody, for being here and for taking time out of your busy day to talk about an important aspect of your client's overall financial plan, which, of course, is long-term care planning. As Bob said, my name is Cindy Horwath, and I am the CareMatters wholesaler with Nationwide. I'm joined with my partner, Kyle Lucas. Between Kyle and myself, we're here to make long-term care an easy part of your practice. But of course, we work with phenomenal partners like Bob, Jennifer, and Melissa, who make this very easy for you to go ahead and streamline and submit those applications and everything. So great team that you have supporting you when it comes to long-term care planning. There's really going to be a couple things that I talk about before I hand it over to my partner, Kyle, and it's going to be mostly focused on our New York product that we launched a little over a month ago. And I want to say before I get into the three things I'm going to mention is that we are committed to expanding access to long-term care planning, whether that's through the enhancements we're making on our New York product or the CareMatters annuity that Kyle is going to talk about in a little bit, making sure that we're able to offer more coverage to people who otherwise might not qualify for long-term care. Our goal at Nationwide is to make long-term care planning a part of everybody's financial plan. And some of the things that we're going to talk about today certainly reiterate that commitment to the space that we have. That being said, three things that I'm going to talk about. First, I am going to briefly touch on some of those enhancements we made to that New York product. Then, of course, the bulk of the conversation is going to be around the tax incentives, specifically to your business owners. And I'll close out with an example of how those tax incentives for pass-through entities or your small business owners actually works. So first, just to reiterate some of the enhancements to our New York product. I have them highlighted. I'm not going to go through every single detail here, but first thing is we did reduce the issue age down to 30. I know what you're thinking, what 30-year-old is thinking about long-term care planning, but it is something that is coming up more and more, especially for high net worth clients. Maybe they are planning on passing this money down to the next generation anyway. This is a great way for them to get their long-term care taken care of when they're young, they're healthy, the pricing makes a lot of sense, and it's going to free up their assets to do other things financially with the rest of the inheritance that they may receive someday. The separately identifiable premiums, that's what we're going to really talk about today, and that's going to be what allows us to provide those tax incentives to your business owners. We did also expand our payment options, so we offer a single pay, a 5 pay, a 10 pay. In addition to that, we launched pay to 65 and pay to 100. So again, committed to providing more affordable solutions to all clients when it comes to long-term care planning. The most exciting thing that I know Kyle and I were holding out for, and we were really excited about with this product launch, is the inflation benefit. So if you ever did a CareMatters product or any long-term care hybrid in the past, you're probably familiar with that 2-year waiting period that your client had to go through before their benefit would inflate. It was confusing to explain to the clients, and quite frankly, it didn't make a lot of sense because it wasn't keeping up with the rising cost in care. That is no longer the case in the state of New York. It works just like it does outside of the state of New York, where the entire benefit is going to inflate from day one. And with that, we offer a 3% compound inflation adjustment. So really, again, just trying to help clients provide better coverage for long-term care when they do need it and keeping up with those rising costs in care. But again, today, we're going to really focus on the tax incentives to your business owners specifically, and how we can kind of do that with those separately identifiable premiums. So the chart that you're seeing on your screen now, it goes through the hierarchy of tax incentives, and it goes from most valuable, I'm not going to say to least valuable, but it goes from most valuable to not quite as valuable as the one on the far left-hand side. So I'm actually going to start on the right-hand side. The right-hand side is going through HSA distributions that you could use to pay for your long-term care premium. So yes, clients can use their HSA dollars to pay for a part of their long-term care premium up to the IRS age-based limits. If you're wondering what that is, I'm going to show you a slide in a moment that'll go through what those IRS age-based limits, but just know that there are some situations where a client could use their HSA to pay a part of their premium. Not something that we see a ton of, but it is something that is available. To the left of that, you'll see individuals who maybe are able to deduct a portion of their premium. Again, not something that we see a whole lot of, and the reason being is that in order to qualify, your client would have to have 7.5% of their income going towards qualified medical expenses. So not something that we see a lot of, especially when they just went through an underwriting process, making sure that they're healthy enough. They probably don't have too many medical expenses. To the left of that, though, the pass-through entities, that's what we see a lot of. I'm going to come back to that. On the far left-hand side, you'll see the C Corps. So if you are working with C Corp executives, we do see these occasionally, maybe 1-2 cases every year, every other year. But ultimately, that's going to be the most tax incentive that we can offer. Basically, what happens is the entire premium is going to be tax deductible to the business, and the long-term care premium is going to be tax deductible to the individual. So great incentive for those corporate C Corp businesses, but again, not something we see a ton of. What we see most of are your pass-through entities. So think about your small business owners. So I actually have done a few cases on somebody who they and their brothers own some car washes. I was talking to a client she's a therapist. She has her own LLC. Landscaping companies, roofing companies, companies like that are typically going to see the most common tax incentives for the CareMatters strategy. So I mentioned this age-based limit, and for those pass-through entities specifically, the entire premium is tax deductible to the business. The long-term care premium is going to be tax deductible to the individual. You'll see on the far right-hand side, we have the year 2026, that age-based limit that I mentioned. You'll notice that the real incentive comes in when they're in their 60s and 70s. That's when they're going to get the most tax deduction. If they're younger than that, there's still some incentive, but it's not going to be quite as great as it is for those clients that are a little bit later in life. But again, premium is tax deductible to the business, and a portion of the premium is tax deductible to the individual. So I'm actually going to walk you through an example of how this would work. So this is a New York client. They're 60 years old, male, and I'm actually going to walk through just again, they're putting in $20,000. They're doing it over a 5-year period of time, fully funded, $100,000 goes in. It's being paid through their business. Day one, their total long-term care benefit is $362,000. Of that, they can take $4,600 per month, tax-free. even though they're getting a portion of their premium deducted, they're still able to take this benefit tax-free. They're young, they're healthy, they won't need this care until they're a little bit later. At that point, their total benefit grew to $736,000. Again, once they need care, that $9,400 is going to be available for them for qualified long-term care expenses, again, tax-free. So thinking about it in terms of investments, if they took that money, invested it elsewhere, that investment would have to earn at least 8.3% guaranteed and tax-free in order to match what we're showing them here. But how does this work from a tax incentive standpoint? I mentioned these separately identifiable premiums, so let me walk you through what that is. We include this page in our illustration for you, so it's very easy to show your business owner clients. So the entire premium is $20,000, as I just showed you. 11,000 of that is life insurance. So we break out, okay, this is the amount that's going towards life insurance, this is the amount that's going towards long-term care. 8,900 is going towards the long-term care premium. So we mentioned that he's 60 years old. I'm going to flip back to this screen. 60 years old, he would be able to deduct $1,800 on that first year premium. Now, when he ages up, the next year he's going to be 61. At that age, he could deduct more. He could deduct up to $4,900, and that's for 2026. As you can see, the IRS typically increases the age-based limit. So in 2027, it could be a little bit more that they would be able to deduct. So did want to walk you through that because, again, this is a pretty powerful way to have this conversation with your small business owner clients, especially to be able to provide them with a tax efficient way to pay for their long-term care through tax deductions for their business, through a tax deduction for them individually, but then also to still have that tax-free long-term care benefit. So I am actually going to stop sharing my screen and I am going to hand it over to my partner, Kyle, who's going to talk a little bit more about our CareMatters annuity.
Awesome. Thanks, Cindy. So just to reiterate what we were talking about earlier, Nationwide is fully committed to the long-term care space. To quote our president, we want world domination of the long-term care market. So with that said, the next iteration or the next logical product launch was our CareMatters annuity product. We have all of our life insurance with long-term care riders, and then our regular CareMatters, and our launch was the next evolution of that. Before I share my screen, I just want to mention why this is such an important product enhancement, because there's nothing really else like it out there. I've been saying there's cousins of this product out there, but nothing really else like it. If you take anything away from what I'm about to say, is you now have the ability to 1035 non-qualified annuities into a hybrid long-term care solution. And I'm going to go through that in a second. But why is that so powerful is every other long-term care product before was essentially built on a life insurance chassis. Now, as we know with 1035 rules, you cannot do a 1035 exchange from an annuity into life insurance. You can go life insurance to annuity, but not the opposite. So I can't tell you how many times I've worked with clients, families, and advisors over the years where someone says, hey, I really need some long-term care protection. I have this annuity that I'm never going to use for income. What can we do with this to help get some long-term care protection in place? Well, before this product launch, we essentially needed to create a taxable event to then go fund some sort of long-term care solution. Either surrender the policy, annuitize the policy, put an income rider. The point was basically using after-tax dollars to then go fund some sort of insurance. Now, since this product is built on an annuity chassis, you have the ability to move those into a long-term care solution. And the tax loophole on this is if you do the exchange, any taxable gain above their basis is eliminated or washed away, however you want to put it, if used for long-term care. So if you have a non-qual annuities with low cost basis and a lot of gain, they're never going to use that. We can turn this into tax-free long-term care protection, and no dollars will be taxed if used for long-term care. So I'm going to go ahead and share my screen. And I don't generally like to show illustrations, but I am on this product because I think it's the easiest way to show how this product works. It is very, very simple. The chassis that this is built on is a 3% fixed annuity. So the client's money is going to grow at a guaranteed 3% rate. But the real powerful part is the long-term care bucket. The clients are going to get 3x in most situations the contract value for long-term care coverage. So let me walk you through this really quick. This is a male, age 65. They're doing a $250,000. This could be cash or a 1035. But for now, let's assume this was cash coming in. Day one, when this goes in force, the client's going to have 3x or $750,000 for long-term care. At the end of year one, their contract value is $256,000. That times 3 will get you a long-term care bucket of $770,000. And we're going to pay out just under $11,000 a month. This is a 72-month or 6-year benefit period. It is what it is. You can't change it. It's a 72-month benefit period. So day one, client gives Nationwide $250. We'll give you $750 and $10,000 a month for long-term care. Now, Nationwide is an indemnity carrier. So that means there's no need for receipts. You do not need to get reimbursed like some other carriers. Basically, you are not at the mercy of the insurance carrier. So in this example, if this client was to have a long-term care event in the year they purchased the policy, we would pay out $10,000 a month every single month, even if their expenses were $2,000 or $3,000, and that is a tax-free amount. Now, highly unlikely this client has a long-term care event in the year they purchased the contract. So this contract value, as I mentioned earlier, it's a 3% fixed annuity. So their contract value is growing at a guaranteed 3% rate, and we cannot change that. Everything on this product is fully guaranteed. We cannot change the crediting rate, ask for more premium, or change their monthly long-term care amount. So as we go forward, in 25 years, when this guy is now 89 years old, his annuity value is now $491,000. 491,000 times 3 is going to get you about $1.5 million guaranteed by Nationwide, which will then turn out and pay out just over $20,000 a month every month, tax-free for 72 months. Now, if you remember what I said earlier, you now have the ability to 1035 non-qualified annuities into this solution. Let's assume this was a 1035 of $200,000. Say this goes in, so you have $200,000 of gain. If he was at a long-term care event in the year they purchased the policy, the first $200 of long-term care benefit is paid out would come out as taxable gain first, but that would also come out tax-free. This is a LIFO contract, so last in, first out. That is where the tax advantages is. So the $200,000 of gain day one, if he has a long-term care event, comes out as taxable gain, and then it would be $50,000 of his cost basis, and then it's a rider extension. So basically the first $256,000 paid out is a reduction of their annuity contract value. And then if they were to pass away, there's nothing left to inherit. Now, let's fast forward again, assuming they don't have a long-term care event in year one. In 25 years, now their annuity value is $491,000, meaning they have $440,000 of taxable gain. That means if they were to have a long-term care event, the first $440,000 of long-term care is paid out as taxable gain first, coming out tax-free. That is the loophole on this product. And then the next $50,000 is cost basis. Now there's nothing left of annuity value, but roughly the remaining $1 million of long-term care benefit is paid out as rider extension. So if you have non-qualified annuities on the books, and again, this isn't approved in New York yet, it is filed, but we know in New York it takes some time to get products approved. But if you have clients outside of New York in an approved state, we can look at those products, those annuities to 1035 into this solution. I have never been busier from a product launch. Just the sheer opportunity of repositioning annuities that clients were never used for income, but are concerned about long-term care. This is a no-brainer for them to take a look at as an option. The other area where this product is going to shine is underwriting. Since it's on an annuity chassis, we are not pulling medical records. It is very minimal underwriting. All we are checking is a prescription history and what's called the DX check, which are basically looking at, do you have any surgery scheduled, things like that. But there is literally only 6 underwriting questions to this product. If your clients can say no to these first 5 questions, they get the product. Underwriter saying, hey, what about this client? They've got this conditions. They come back to us and literally say the same thing. If they say no to these 5 questions, they get the product. Now, you'll see a lot of these are activities of daily living or ADL related. So are you in a hospital? Are you confined to a bed? Are you in a wheelchair or a walker? Question 3 is the activities of daily living. And I do want to point out question 4 here. These are the medical conditions that'll knock someone out for this product. It's the obvious ones: MS, Parkinson's, Huntington's, back surgeries with ongoing issues, weakness, or limitations, memory loss, COPD, or cirrhosis of the liver. If someone has those conditions, stop the application. They're not going to apply for this product. But one thing I do want to point out is you will notice there is no cancer question on this. One of my peers, he's 52 years old. He was diagnosed with brain cancer at 47 years old. He couldn't get long-term care even as a Nationwide employee. When this product launched, he is policyholder number one on this because there is no cancer question. So clients who may be declined for other products, and again, not living in New York, this is a great alternative for them to get some sort of long-term care coverage. And then question 5 here, I do want to point out because I do see some confusion. This says, in the last 5 years, has the proposed insurer been medically advised to have any surgeries, hospitalizations, treatments, or tests that was not completed? The key word is not. For example, I had a guy, he had open heart surgery 3 months ago and got the product because he could say no to all these products, or all these questions, excuse me. Basically, if your clients can say no to these first 5, they will get the product. And you'll see this in red here, and this is literally what's on the application. Now, you'll notice there's question 6 down here. In the last 2 years, has the proposed insured been diagnosed, treated for any of these conditions? If they say yes to any of these, there is the potential to knock their leverage down from 3x leverage to 2x leverage. They're still going to get the product, but there is the potential to knock their leverage down because they may have some of these issues. Now, there are situations where I've seen someone say yes to one of these and still get the full 3x leverage because maybe it was a mild prescription, or maybe it's a combination of two or three of these conditions that'll lead to a knockdown from 3x to 2x leverage. They're still going to get the product, but when working with clients, set the expectations up front that say, you're still going to get the product. It may be 2x, but there is the potential for you to still get the full 3x coverage. So it's just something to be considered. I know this is kind of a wide range, but all we are checking is prescription history and that DX check from behind the scenes. So anyone with underwriting issues, this is not what's called the decline product, but I've seen clients who may not qualify for other life-based products do qualify for this. So any health issues, this would be a good product to look at. The last area where this is going to be a home run for you is older issue ages. We can issue up to age 80 with this product. A lot of other life-based long-term care products, 70 or 75 average may not have made sense with those products. Now, this leverage and you get that guaranteed 3% growth. This product makes a lot of sense for those older issue ages. What I'm seeing is males 67 and up. This is probably a more competitive solution, some of our other life-based products. And then females is usually around 65. We will look at both products if everything's on the table to provide what's the most valuable option to them. But the point is, the older issue ages is generally we're seeing as the best bang for their buck. Now, the other thing I want to leave you with is Nationwide is annuitant-driven carrier on our annuities. We are not owner-driven. We are one of the only that is annuitant-driven. Why is that important on this product? For annuitant-driven, it means that, let me walk you through a case. I had a husband. He had an $800,000 non-qualified annuity. We can also do split 1035 exchanges at Nationwide, meaning we can take one policy and split it into multiple contracts. So we did a 1035 exchange of that $800,000 to Nationwide, and the husband bought his own CareMatters annuity where he was the owner, he was the annuitant, he was the insured, just like a typical 1035 exchange. We split the other half and changed the annuitant to his wife. He was still the owner, but now the wife was the annuitant and insured. So the short of it is we got her long-term care coverage off of his asset. So if you have any situations, there's a couple ways you can slice and dice this product to get the whole family or both spouses coverage. It's only limited to spouses because it's an annuity, but there are ways we can slice and dice this product. And then lastly, there is a joint version of this product where you can have both spouses sharing in a pool of funds. So if you have an existing annuity where it's joint ownership, we also have a version of that where it's joint ownership where they would share in that pool of long-term care funds. So I don't want to go too far in the weeds there, but it is not, again, if you have clients in Florida, South Carolina, or we can look at it to see if it's approved. And it's a great opportunity to reposition those lazy annuities, non-call annuities that they're never going to use for income and get them meaningful long-term care coverage to protect the rest of the portfolio and those tax advantages that I mentioned earlier. So I will stop there, not to go too far in the weeds, but if there's any questions or follow up, and Bob, I'm not sure if you want to open it up or have any closing comments.
Thanks, Kyle, and thanks, Cindy. You were a little bit choppy there, Kyle, but I think we got 98% of what you shared. So thanks for that. I did send a message through. Yeah, that's okay. I did send a message through the chat. If anybody does have any questions for either Cindy or Kyle, now is your opportunity. I do want to reinforce the fact that, especially since a fair number of people are from the state of New York, remember that ability to now split premiums with CareMatters 2, the life product with the rider in New York, because we can segregate those premiums, the long-term care portion of the premium is eligible not only for the deduction, and I agree that holy grail is in that business market, as Cindy shared, but even at the individual level, you now have the ability to get some tax leverage because of the New York State tax credit we have. Now, there's some limitations there that came out kind of in the middle of COVID back in, back in 2020 that put some limits on it, but it's still the most attractive state tax incentive for long-term care insurance in the country, I would argue. And so the new CareMatters 2 product in New York gives you the ability to do that. And I agree. I think, Kyle, the opportunity for that annuity product is tremendous. And we really haven't hit our stride with it yet as an industry. That fact that we had that enhancement to Section 1035 to allow for those tax-free exchanges, boy, what an opportunity we have. I don't see any questions yet. This is your chance, gang. So if you've got them before these guys get out of here and Kyle gets to the rest of the rest stop, wherever he's pulled over here on the road, now's your chance. While we're waiting for those questions, Cindy, I'm going to go back to you. Anything else you want to add I know we went fairly quickly here today, but anything else you want to share with the group as we start to wrap up and check for questions?
Yeah, no, I appreciate it. I mean, obviously, I think the biggest thing is we kind of started with it, that we are committed to really making sure that we're providing a suite of products for all clients when it comes to long-term care planning. Specifically in New York, this was a long time coming. We definitely had to put in some work there to get the regulators to, give us our blessing and get this one through, but we got it. So we're really proud and excited of our team. But I think ultimately Kyle touched on a lot of really important information. One of the things I saw that Kyle had on his screen, he didn't necessarily share it. We joke that it's actually one of our best marketing pieces for the state of New York, and that's our non-resident form. So again, if they have a residence outside of the state of New York, or if you are an advisor outside of New York and the client is coming to your office to complete that application, they have that ability to do that as well. So keep that in mind, because that definitely, it opens up the doors for us.
Appreciate that. And again, Cindy and Kyle are going to be splitting their time at our upcoming carrier days. If you haven't already signed up for the carrier days, we've been including the registration link in each of our e-newsletters that goes out every week. If you don't have that handy or you need a follow-up, go ahead and touch base either directly with me or with Melissa Frazier, and she can get you signed up here. We are actually headed out. We're going to have our first one on Tuesday on Long Island. So it is coming up next week. Frank, I think you had your hand raised out there. I'm going to see if I can go ahead and unmute your line. I'm going to go ahead and let you go ahead and let's hear your question, Frank.
This regarding Kyle's point on the 1035, the taxable portion that normally would come out, it was a little bit ambiguous in regards to his description, because it's coming out as a benefit, therefore there's no tax on it, so it's totally tax-free, correct?
Correct. Yeah, if you want to go down a rabbit hole, it's Pension Protection Act or PPA of 2006 compliant.
Okay.
But yes, yep, it is tax-free.
Okay, I'm clear then. Thank you.
Yeah,
Yep.
that's one of the big benefits, right, Kyle? I mean, the fact that you can take inherent gain. If you have any clients out there or prospects that have non-qualified annuities, especially if they've got a ton of inherent gain in them and they haven't done any long-term care planning, that should be your first phone call, getting to them, because if they try to take money out of that existing annuity and use it for long-term care, immediately taxable on a LIFO basis. So to be able to tax that otherwise inherent gain in the existing annuity with tax-free money, very powerful.
Yep.
Tag on a 2x, 3x potential benefit there. Talk about a win-win.
Yeah. And we could also do partial 1035s as well if they don't want to move the full contract.
And
That's huge too.
on that too, it is an annuity, but it still has access to all of our caregiver advocate for claims process and everything. So to your point, Bob, if they were going to leave it in that annuity and, use that distribution to pay for their care, they certainly can. But they're also going to get a ton of extra services for themselves, for their family, to find care in their area, to make the claim process easy. And certainly they're going to get much more leverage than they probably would with their existing annuity. So.
Absolutely. Frank, did you have your hand up again?
Yes. Can you hear me, Bob?
Ken, yeah, go ahead.
Yeah. Okay, great. What if the client has the annuity registered as joint? How does that work if it's currently joint owners on the contract? They 1035 it over. How does that work in regards to splitting it if they had to for care?
Sure. Yeah. So we have a joint version of the product where it, from an ownership perspective, it would still be a joint product, but it's basically a shared pool of funds on our joint contract. It's 109 months or payments or 9 years of coverage. I believe that math is correct. It is not like 50-50, 75-25. So one could use 9 months and the other could use 100 months. One could use all 109. But the other key is they can both go on claim at the same time. So if their monthly benefit was $10,000 a month and they both have a long-term care event, we would pay out $20,000 a month, but it would obviously drain their pool twice as fast.
Okay, thank you.
Yep.
Last chance for any questions, gang, before we let Cindy and Kyle go. Any other questions out there? I don't see anything in the chat. And I don't see anybody with any hands raised. Okay. All right. I think we'll wrap up. Hey, Cindy, Kyle, really appreciate you guys making some time for us today. Kyle, pay attention to the road while you're driving. Looking forward to seeing you guys over the next couple of weeks at our Carrier Day events. Looking forward to seeing many of you as well. So we'll catch up with you next week, if not before. Again, if you need help registering, if you haven't already registered for those events, reach out to me or reach out directly to Melissa. She's handling all the logistics, and we'll look forward to seeing everybody soon. Thanks a lot, guys. Appreciate you being here.
Thanks, Bob.
Thanks, Bob.
Take care, everyone.